You need to watch this video before you think about buying an investment property in your self-managed super fund. Now, we're going to break down the advantages and the disadvantages of buying a property within your super. And I'm going to share exactly my thoughts as to why Emily and I probably won't look at buying an investment property in our super fund anytime soon. My name's Luke. I talk about all things real estate, renovating, and financial freedom. Make sure you hit the subscribe button down below, drop a like on this video, and head over to purposeproperty.com.au if you're looking for a buyer's agent. So what's the big deal? Now, buying a property in your superannuation fund has been popular over the last 10 to 15 years. Plenty of people have want to put their money, that they've earned in their day job to hard work and controlling that themselves in their own superannuation fund. Typically, when you invest in an industry super fund or a retail fund, you don't have much control and really you just diversify in an ETF and buy a broad range of shares in the stock market and typically a mix of bonds as well. But the rise in popularity of controlling your own money and doing that through an SMSF has taken place in the last 10 to 15 years, and it allows people to control where they invest their money. That could mean in alternate assets, in startups, in property, and in shares and bonds as well. Now, before we get all negative in self-managed super funds, there are definitely some advantages to doing that. So let's talk through the advantages of investing in property in your self-managed super fund. The first is, like I said, is control. So you control your self-managed super fund and you have full autonomy. You're not waiting on an investment manager to make any decisions for you. If it's going to be, it's up to me, is the saying. So it's really up to you, if you're managing your self-managed super fund, to put that money to work and ensure you get an investment return that can allow you to retire. Now, some other advantages is that you can use leverage. So you can take maybe $400,000, $500,000 cash that you might have built in your self-managed super fund, and you can use that leverage by going to a bank, obtaining debt, and buying an investment property. So that really allows you to turn a couple $100,000 into controlling maybe $1 million worth of assets or more. And that means you're controlling a larger asset base and potentially getting growth and cash flow from that asset base as well. The other great thing about managing your self-managed super fund is you're really looking for a long-term wealth play and you're potentially looking to set yourself up well for retirement. Most people tend to manage their super funds when they're moving towards their retirement phase to gain a bit more control and to potentially take on some trades that they're more interested in and want to be more of an active investor. It's time to look at the disadvantages, and here's some reasons why I won't be investing in investment properties through my self-managed super fund anytime soon. The big thing with buying an investment property is there are a limited number of lenders if you want to take on debt through your self-managed super fund. They also typically charge quite a high interest rate. For example, the interest rate for investing in your personal name could be between, say, 3 and 4% at the moment. But investing in a self-managed super fund for an investment property, the interest rate you could be paying could be anywhere between 5 and 6%. So that can make a big difference in terms of the cash flows that the property brings in. And there's not many investment properties out there that return more than a 7% gross yield. Really what this means is if you're going to be paying a higher interest rate, which is the biggest cost for owning an investment property, then it's likely to reduce the cash flows and potentially even have negative cash flows held within your self-managed super fund. The banks and lenders are really reduced here, and they can also reduce your lending capacity. Typically, these lenders want lower LVRs. In your personal name, you can really leverage up to 95% LVRs, but when you're buying in the trust structure through your SMSF, you might be able to get up towards the 80%, but it's more likely that you're going to be held around the 75, 70%, and 65% LVRs, depending on the lender. These lower LVRs mean you need to put more cash in the deal, which is good from allowing better return to yourself, but it also doesn't allow you to leverage as much in your SMSF and potentially have more gains on terms of controlling a larger asset base. Now, some other points around self-managed super funds is I don't like the idea of having all this red tape and restrictions around your lending and the audits and tax returns that are required. There are costs involved in setting up the self-managed super fund, there are costs in maintaining it, and there's complexity in understanding what you can and can't do. For myself as an investor, I also want to have asset protection and grow my wealth. But one thing that's really important to me and my family is simplicity in our investing. When we look to buy investment properties and grow our wealth, we don't want to create such complex structures and have to jump through hoops all the time and create unnecessary costs and burdens on ourselves in terms of filing out paperwork and completing the tax returns for the SMSF as well as our personal returns. So to me, the payoff's not quite there. If I had loads of cash which was going to waste, then yes, it would be a great idea to manage my own money. But for the average Australian that has a couple $100,000 built up in their super, in my opinion, I'm not going to take that money and start an SMSF and invest it in property. For me, the complexity and red tape around investing in an SMSF is a massive disadvantage. I don't want that complexity in my life, and I want to set up my investing structures in a simple and understandable way that means I manage them with a minimum amount of time and get to spend my time not doing tax returns and not covered in paperwork and spending time with my family and doing activities that I love doing and passion projects that I'm passionate about. It sounds very corny, but it's true. So there's the advantages and the disadvantages of investing in property using a self-managed super fund. If you're the type of person that's cashed up and you're maximizing your superannuation contributions to the $27,500 limit each year, and you're looking to take control of your situation and you might be moving towards retirement and accessing that super, then maybe investing in a self-managed super fund for property might be for you. But for someone like myself that's a little bit younger, not maximizing their contributions at the moment to the super, and they want someone else that's a retail or an industry super fund to diversify their portfolio, maybe use their super to invest in shares and invest in property in their personal or in a trust structure, then maybe not using an SMSF and sticking with the retail or industry funds better suits you. So for Emily and I, we're really that second person. We're not maximizing our superannuation contributions at the moment, and we're not looking to access our super anytime soon. We want our super to be in a retail or an industry fund and invest in the stock market. We're going to invest in property in our personal names and in trust structures and use our superannuation fund through a retail fund and let them manage it with low fees and really diversify that way. Now, whatever you decide to do, whether it's investing in your personal name or in a self-managed super fund, I wish you the best in your investing journey and click this video over here for more things on real estate. I'll see you in the next video. Peace.